Good day, my name is Ed McFerran. I'm House Counsel for Tax Deferred Exchange Services. We're a national qualified intermediary company, and we provide services for our clients throughout the United States, Alaska, Hawaii, and even the Virgin Islands. Today, we're going to talk about a subject called when may an exchangor get money from a tax deferred exchange? This is a question that occurs on a regular basis in our practice, and probably the reason that you're listening to this video today is that you may have talked to one of our staff members about this particular subject, and we find that it happens so often that a video like this will in many cases allow clients some further understanding. We'll send along some brochures and information, but hopefully this video will provide you specific information as to when you can get money from your tax deferred exchange. The first thing we need to understand is that a tax deferred exchange comes to us from the Internal Revenue Service through Congress. Tax deferred exchanges originally started in 1921. They've been with us for a long time. And the current rules for tax deferred exchanges are really the outgrowth of the 1980s, where the current forward delayed tax deferred exchanges came into existence. As a result of those rules, the parties are in a safe harbor as long as they operate within the time constraints associated with the tax deferred exchange. Safe harbor rules provide us a 180-day time period for the completion of a tax deferred exchange. Within the 180 days, they provide a 45-day time period for declaring, and then an additional 135 days to actually get the acquisition property closed. Many clients will look to us and seek opportunities to obtain some money from their transaction. We call this boot. We have another video that goes through the boot process in detail, so if you're looking for more information than what's provided in this video, ask one of our staff members for the specific video on boot. But suffice it to say, for purposes of our video today, boot is defined as anything to which an exchangor receives benefit, specifically cash, that does not preclude the exchange from qualifying, but provides that the exchanger will have to pay capital gains tax on those monies that are received. In short, there are 4 time periods where an exchanger can get money out of a tax deferred exchange. The first is at the closing of the relinquished property. This is important. We need to know from the exchanger prior to the time of the closing if the exchanger will wish to have some money coming from the transaction. Does it happen often? Yes, it does. Approximately 27% of the transactions that we handle will have an exchanger seeking some money at the closing of the relinquished property. It's totally appropriate. It does not preclude the exchange from qualifying. The exchanger, of course, has to understand that they're going to pay capital gains tax on the money that they have coming out of the exchange account. So that's the first time that it can happen. It happens at escrow. The money comes from escrow. It doesn't come from the qualified intermediary. And then the money goes into the exchange account and becomes impenetrable for a goodly length of time. If you're completing a tax deferred exchange, the second time to which you can receive the money is on the 46th day after the closing of your relinquished property. If you do not declare any properties during the 45-day declaration period, your exchange ends. On the 45th day at midnight, your exchange is over with, and as a result, on the 46th day, we will return to you all funds in your account, less any charges associated with handling the account up to that time period. Let's pretend that you do declare, but you are not able to acquire any of the properties that you declare. Your exchange period then ends on the 181st day, the day after the 180th day of your exchange, and on the 181st day, we're able to distribute to you all funds in your exchange account, because at that point in time, your exchange is over under federal law. The fourth time that you can obtain money is if you have acquired the replacement properties that you choose to acquire, and there happens to be some money left over in the account. On the day after the closing of the last property that you declare, we can distribute whatever monies are left in the account. So let's assume that you've declared 2 properties, and you purchase the first property on day 110, you purchase the second property on day 120. On day 121, we're able to distribute to you any remaining balances in your exchange account because at that time, on day 121, your exchange is over because you have acquired all the properties that you can acquire under your declaration, and that allows us to close the exchange in the exchange before the end of the 180 days. This has been a general overview of the times when you can obtain money from your exchange account. It doesn't replace the valuable advice that our staff can give. You may have specific questions regarding your situation. Please contact our staff. We're available daily to answer your specific questions and give you advice that relates to your particular situation. Good day.